All right, second video for the TR questions for chapter 19. And the last chapter 19 video is covering 19-7 and 19-8. And we're talking about that asset ceiling in these questions. So we have UCLM Inc., who has a defined benefit pension plan at the end of the year 20X4. Our pension fund assets were $7,670,000, and the defined benefit obligation was $7,250,000. Invoking the asset ceiling caps, the net defined benefit asset at $315,000. So we want to first prepare the journal entry to correctly recognize the net defined benefit asset. I'm not going to read 19-8 yet. We'll focus on 17 first. So the first thing that we need to take care of here is looking at what our current net defined benefit asset is. Okay, so this is our current net defined benefit asset. And in order to determine what that is, we want to look at the pension fund assets at the end of the year 20X4 and our defined benefit obligation. Okay, so $7,670,000 is our asset, and we're going to subtract from that $7,250,000 being our obligation. And when we do that, we get an amount of $420,000, which is our current net defined benefit asset. Okay, but the ceiling asset test indicates that the asset can be no higher than $315,000. Okay, that is the maximum amount available as a future benefit to the employer in the future. So we need to make an adjustment for the difference between our current asset and our ceiling. Okay? So the difference between the two, which is $105,000, is going to be our journal entry. When we have this situation with the asset ceiling, we put it to our OCI, our pension, and we increase that net defined, we decrease the net defined benefit asset, which really is a credit because it relates to the net defined benefit liability, right? That is the same account. It just depends on whether it has a debit balance being an asset or it has a credit balance being a liability. So right now, the balance is an asset, so a debit balance for $420,000, and we want to bring it down to match with that ceiling, which is $315,000. So we need to reduce that account by 105. So we are going to credit that account and debit our OCI. Okay? Sorry for any confusion on that. Not sure what just happened there. All right. There we go. Sorry, the calculation poofed on me for a minute. So 19-8, we have our net interest with asset ceiling amount. We are referring to the data in 19-7 and the related solution for the opening balances, which we just did. For 20X5, the following information is provided. The market yield rate for high quality corporate bonds with a similar term and identical currency is 5.5%. We're going to need that, so let's pull it out of the question. At the end of the year. On April 1st of 20X5, the contribution of $560,000, so yield rate, contribution, was made to the plan assets. Pension payments to pensioners are made evenly over the year and totaled $230,000. So these were our payments on the plan. We need to calculate and record the second element of pension accounting for the defined benefit plan. That is, calculate net interest cost and prepare the entry to record interest cost. Calculate the three components of net interest, being our interest on the defined benefit obligation, our expected earnings on fund assets, and the interest on the effect of asset ceiling. Okay, so let's start here with our interest expense. So we're going to look at the defined benefit obligation, and we are starting with our beginning of the year balance, okay, which was $7,250,000. So we need to take the weighted average for the benefit payments, okay, because pay attention to our dates here. We are not calculating this for a full year. Okay, we're calculating it for a half year, so 6 out of 12 months. The payments to pensioners were made evenly over the year, and their total was $230,000. So we're looking at how much was paid out over 6 of the 12 months. Okay. So the weighted average for the benefit payments, taking that full $230,000, I guess I wrote this out for a reason to use in our Excel formulas, multiplied by the half year gives us a value of $115,000. And I'm actually going to make this a negative number so it makes it easier when we are doing our total calculation at the end. Okay, so the weighted average balance outstanding then, I'm going to sum, and it's going to give me $7,135,000. So our interest expense at 5.5% based on this amount, the $7,135,000, is going to give us $392,425. So next we're going to look at our interest income on our plan assets. We are looking at the pension plan assets at the end of 20X4, which we know was $7,670,000. Okay. And again, we need to look at weighted averages here. So instead of looking at the weighted average of our payments, here we are looking at the weighted average of contributions. Okay. So our contributions were $560,000. Again, we're going to multiply by the portion of the year that it relates to. What did it say about that? I'm sorry. I need to read back for a second. So April. So April to the end of December is going to be 9 months, right? 9. Okay, so 9 out of 12 gives us a total of $420,000. Next, we bring in the weighted average for the benefit payments, okay, which we calculated above as 115. When we sum all of this together, it's going to give us the weighted average balance outstanding, which gives us $7,975,000. So our interest income, multiplying this by 5.5%, gives us an amount of $438,625. Okay. So now we've looked at our interest expense as it relates to the obligation. We've looked at our interest income as it relates to our plan assets. Now we look at the interest income on effect of the asset ceiling. Okay? So the effect of the asset ceiling, we want to take that balance at the beginning of the year, which is what we calculated up above, right? That 105. So grab that. So then we are going to multiply that by our yield rate of 5.5%, okay, using the same interest rate the whole way along, okay? So that is going to be the interest income on effect of asset ceiling. Now we can calculate our net interest income, okay? So 438,625, we're going to subtract the effect on our asset ceiling, and we're going to subtract our interest expense, okay, which is going to give us an amount of 40,425. Okay, so our journal entry, increasing our net defined benefit asset and our interest income, okay, interest income, revenue, increase with the credit, for the amount that was just calculated. All right. So one thing, do I want to go there? No, I don't want to go there. Let's leave it at that. Again, journal entry, increasing that asset and increasing our interest income as well. So that brings us to the end of the technical review questions for chapter 19. So as I said, I will extend that quiz out for a week to give you time to watch these videos before attempting the quiz. So it will actually be due at the same time as your chapter 20 quiz. Okay.